Today on 3 Cents, we talk about how your credit score impacts your mortgage. So number one is going to be your interest rate. So there's multiple ways that your credit score is going to affect your interest rate. The way we look at it is your credit score goes into brackets. If we're talking about the NFL season kicking off, and we're talking about brackets and betting and all of that, your credit score works the same way. Every 20 points up or down, that's going to have a different impact on your interest rate, as well as a different impact on how your approval is going to work, which we'll get into later. But as far as your interest rate goes, the better your credit score, the better your interest rate. So if we're talking about a conventional mortgage, you ideally want to have a 700, 720 or higher. Once you're in the 740, 760 range, it does not get better than that for a mortgage. You're in a beautiful spot. Once you're below 700, there are some conventional deals that will work out great for you. But realistically, you want to be in that 700 or higher. And anything below that, you're going to be switching more so to an FHA mortgage, in which case, with that lower credit score, FHA is still providing a great interest rate and a great deal for you, just not as sweet as a conventional deal with a high credit score would be. So be aware of how your credit score is going to affect your interest rate. Number two is going to be your down payment. Likewise, brackets. If you have a high credit score, you're more likely to get approved for a low down payment. There is a traditional down payment option of 20% down. That is the ideal scenario. That is the tradition. That's what everyone thinks you need to do. You could put 15%, 10%, 5%, 3.5% for an FHA, even a 3% for a conventional loan. Keep in mind though, the lower your down payment is going to be, the higher your credit score has to be more likely to get that approval. It's not that you won't get that approval with a lower credit score, but when those are getting denied, it is usually because of that lower credit score. So keep in mind of how your higher credit score is going to impact the qualification of your mortgage and your down payment. Next is going to be number three, getting approved or not. Your credit score has a direct impact on whether your mortgage is going to be approved in the first place. So again, the higher the credit score, the more likely you are to be approved. And we're going to go back to the bracket system. Every 20 points higher gives you a better rating of getting approved. Every 20 points lower gives you a rating of getting denied or less likely to get approved. So keep in mind of how that higher credit score is going to work out for your approval. Now I'm going to emphasize a little bit more on how these approvals work. It'll decide whether you're getting approved in the first place or not. It'll decide whether you're getting approved for only a high down payment or a low down payment. It's going to be deciding whether your deal is going to require that you show retirement account, that you have extra assets, whether it be checking, savings, liquid account, or whether it be 401k, IRA, retirement, and a reserve account. The lower that credit score, the more likely you're going to need reserves or savings to actually get that approval. So we can make this all very simple for you, give you the peace of mind that you need as long as you call us ahead of time when you're looking to get pre-approved to go buy a home, or if you're even thinking about refinancing your mortgage. We can look at your credit today and tell you what you need to do so that in 1 month or 2 months from today, you have a better credit score, better approval, better deal on your new home purchase or on your refinance. And that is how your credit score impacts your mortgage.